Hello again, everyone, and Happy New Year. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today is Sunday, January 14th, 2024. In our previous December 31st Following the Money podcast, we said that the Asbury Six risk management model had been on a positive bias or a bullish status as of November the 2nd. The Asbury Six actually shifted to a negative bias as of the close on Friday, January the 12th, after capturing an 11% advance in the S&P 500. More about that in just a minute when we're going to take you into the research center and we'll have a look at the latest configuration in the Asbury Six. Today I'll be talking about what some of our latest data-driven market analysis and quantitative models are saying about the latest financial market conditions. That is, when to be on offense and looking for new opportunities, and when to be on defense and protecting your capital. Now, let's follow the money. In this podcast, we're going to go inside Asbury Research's Research Center, and we'll introduce you to some of our data-driven models and some of the latest signals that they are giving us, telling us about the health and current status of the various parts of the financial markets. So this page is what you get if you go to asburyresearch.com. There's a lot of information here if you're interested about us and learning more about us. Up in the corner here, this little hamburger-shaped button is how you log into the Research Center. It's for our premium subscribers only, but we'd like to show you the Asbury Research or the Asbury Research models today, and specifically we're going to look at the Asbury Six. So we'll log in here and we'll scroll down. And you'll notice that at the top is where all of our models are. Easy access. Most people come in here who are subscribers, they want to see what the models are saying. And then if they're interested in our recent reports, they can scroll down and they have access to all these reports, which are organized chronologically. And you can also search by topic or by date or whatever you want to do. So let's start by looking at the Asbury Six. The Asbury Six, you can see it's negative as of January the 12th from positive as of November the 2nd. Updated on Friday, January the 12th, to show that there are 4 negative constituents out of the 6. The way the Asbury Six works is the initial version of this was probably 5 or 6 years ago. I built it for myself internally. I've been doing this for 40 years, but the day-to-day volatility of the market was just so intense at certain times that it was really hard to tell what the condition of the market was. If you're looking at the S&P 500, you walk in one morning and we're down 40, and the next day we're up 30, and then the following day we're down 50. Very easy to get thrown off your game. I don't care how long you've been doing this with that kind of day-to-day spikiness of the market. So my son Jack and I started back testing all of my favorite tactical tools, pairing them up in different groups to find out what would be a very good day-to-day method to determine the daily health of the market, much like a doctor does when he has you in the office for your annual visit. He puts you up on the bench and he starts checking your pulse and your reflexes and your blood pressure and so on. That's what this was meant to be for the market, and it's very good at it. So it's updated on the close, usually about 2 hours after the close every day. 4 or more constituents in either direction, it indicates a directional signal. So what does that mean? It means that from November the 2nd, 4 or more of the 6 were green or positive. So you can see as of Friday, for the first time, and again in a couple of months, we have 4 negative. They're barely edging into negative territory. So does this mean you sell everything today, and go into the turtle and just kind of wait, for the market to get better? No, this is a very sensitive tool. It's telling us that the market is starting to lose its internal strength. The longer that this stays red, 4 or more of these stay red, the more significant the signal is, and eventually, if we are indeed turning into some kind of a correction here, you're going to see all 6 of these turn red at some point. But for right now, we got the rate of change in the S&P. We have investor asset flows in the SPDR. We have trading volume in SPX, and we have market breadth in the NYSE, all edging into negative territory. We will continue to watch this and see what progresses from here. This is meant to be sensitive. It turns about 9 times a year. There are 9 cycles, let's call them, from green to red or from red to green. There are 9 cycles a year. It's meant to be very sensitive like that because it's a sensitive tool. You can see what normally happens is when the market is sideways, there's more herky-jerkiness to the metric. In March and April of last year, you may recall, the market was in a tight range. It was jumping all over the place. You're getting a lot of ups and downs here, a lot of up and down arrows. But it catches the bigger trends at a very early stage. It caught this one in November, obviously, quite well, that we got out on Friday. May of last year, the middle of May of last year, it rode that all the way up to the high that we made at the beginning of August. And then prior to that, the latter part of 2022, it caught the move from October to December. So that's what this does. Right now, it's telling us that the market is starting to soften up, and we should be paying attention to little subtleties that we see in the market that may be important. Let's move over to our SEAF model, our sector rotation model, and that is right here. So we'll scroll down and we'll take a look at this. This was also updated at the end of this past week. So heading into this week, which is holiday shortened, there's only 4 days to this week because of the holiday. Our SEAF model retains its December 26 long overweight bias in the communication services sector, which is ticker XLC, and has also signaled 2 new overweight opportunities. The premise of the SEAF model, which we introduced to our premium subscribers years ago, 4 or 5 years ago, is to invest in the sectors that the money is going into and to avoid the sectors that the money is coming from or moving out of. As simple as that. We're not trying to handicap the Fed or who's going to win the election or what's happening with the war in Ukraine or any politics of any kind. We're simply following the money. Generally speaking, when the money chases an asset, the price of the asset goes higher. That's all we're doing. We're letting the money tell us what the smart moves are, and we follow those. So that's the SEAF model. There's other models here. We're not going to get into those today. The next thing I'd like to say is I just wanted to say thank you to all of those folks who attended my Thursday, January the 11th online presentation to Fidelity Investments. It was entitled A Look into 2024 with Asbury Research. This is my 10th year presenting these educational videos for Fidelity, and I guess they haven't gotten tired of me yet, as we had an enormous turnout. Thousands of investors showed up. Thank you for that. Fidelity is making the presentation PDF, which includes all of our models, latest signals, and more free to their customers. So if you trade through Fidelity and you want to see a copy of that PDF, you can contact them. You could also contact us if you like. The way you do that is you go up here to the contact tab, fill in your information here. Down on the bottom, put your reason for inquiry and shoot that over to us, and we can also send you a copy of that PDF. Also, while I'm here, about the models, if you're curious about the models, go up here to models, and then you can scroll down and you can find out a lot more information and videos. Here's one I did with IBD about the correction protection model. Click here for more information about any of these. This is CPM, and then we have the Asbury Six. Again, click here for more information. There's some hypothetical backtesting information there, and also here's one for the SEAF model. Again, you can click for more information. So that's how you get around there. Finally, well, 2 more things. For those that are interested in the Asbury Research's models, in the Asbury Research quantitative models, we are pleased to announce that investors can now trade the SEAF model and the correction protection model, or CPM, through a relationship that Asbury Research has made with an independent registered investment advisor that we have authorized and partnered with to execute those trades for you within your own portfolio. Contact us via the contact tab that I just showed you at asburyresearch.com, or you can call Asbury Research's office 888-960-0005, and we'll give you further details about that. Finally, I'd like to announce that my son and I, my son Jack, who's my partner and colleague in Asbury Research, we build the models together. We're going to be taking part, I should say, in the Chicago Polar Bear Club plunge in the frigid waters of Lake Michigan on January the 27th to raise money for a handful of Chicago families in dire need. It's a very good charity. My son Jack has been doing it for years, and he talked me into doing it with him this year. I just hope it isn't 10 below on the 27th of this month the way it is today, as I'm looking outside to see what the temperature is. For further information, you can find me on LinkedIn. Scroll down to the 23rd Annual Polar Bear Plunge Fundraiser. You click on it, scroll down, and you see Asbury Research Arctic Aid. All you do is click on that. And if you'd like to contribute to what we're doing, that would be great. It'll help me help to keep me warm when I'm frolicking around in Lake Michigan in January. So there it is, our latest bi-weekly Following the Money podcast for today, in a short synopsis of what we think is particularly important to pay attention to as we move into the beginning of a brand new year, as we move into the beginning of 2024. We'll see you again right here in about 2 weeks with our next Follow the Money podcast. In the meantime, you can subscribe to the Asbury Research channel on YouTube for more podcasts and data-driven trading and investment information just like this. If you're interested in getting more information about us and our premium services for individual and professional investors, just visit asburyresearch.com, as I showed you before, and use the contact tab. Thank you, everyone. Have a nice January, and we'll see you with another one of these in about 2 weeks.